Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And let me tell you, our latest dive has some interesting revelations, especially when it comes to how banks are navigating these economic waters today. So buckle up because we are about to look deep inside Middlefield Banc Corp's most recent financial report for the third quarter of 2025, and there are some eye-opening numbers in here that tell a compelling story. Before we dive in, a quick word: if you appreciate getting straightforward insights from complex financial documents, make sure you are subscribed to Corporate Decoder and for even more exclusive content. And to join the conversation, hit that Discord link in the description below. Now let's get right into the thick of it. Middlefield Banc Corp, or MBCN, as they are known on the stock market, just dropped their quarterly report, and like always, the devil is in the details, especially in those financial tables that tell us where the money is really coming from and going. Right off the bat, looking at their balance sheet for the 30th of September 2025, we see total assets are sitting at a cool $1.98 billion. That is a pretty solid number and an increase from the $1.85 billion at the end of 2024. So the company is definitely growing its footprint. One of the biggest players on their balance sheet is their loan portfolio, and it is pretty diversified, but let's zoom in on their commercial real estate loans, specifically owner-occupied properties. That portfolio saw a significant jump from $181 million at the end of 2024 to over $221 million by September 25. That is a whopping 22.1% increase. This signals a strong push into this particular lending area by the bank. Across the board, their total loans also saw a healthy climb, reaching $1.61 billion. That is up by about $87 million from the prior year end. This growth in lending is usually a good sign, indicating the bank is actively lending money, which is its core business. Now let's talk about what belongs to the owners. Their stockholders' equity increased to $224 million. That is a positive movement and reflects the company's retained earnings growing, which is a sign of profitability. But of course, it is not just about the top line numbers. We need to dig into how they are making money and what is driving those profits. Looking at their income statement for the 3 months ended the 30th of September 2025, net income was $5.3 million. That is a significant jump from just $2.3 million in the same quarter last year, so they nearly doubled their profit in just 1 year. Their primary revenue driver is net interest income, and for the third quarter of 2025, it hit $17.6 million. That is a solid 16.5% increase compared to the previous year. This rise is largely thanks to that growth in their loan portfolio and a better grip on the interest rates they are paying and receiving. Beyond just lending and borrowing, the bank also brings in money from other sources, what they call non-interest income. This category saw a nice bump to $2.3 million for the quarter, up from $1.7 million last year. What is interesting here is a mention of derivative fee income, a new source of revenue that seems to be paying off. Now let's talk about expenses, because that is where a lot of potential issues can hide. Total non-interest expense crept up to $13.1 million for the quarter. This is mostly driven by higher salaries and employee benefits, a common cost for growing businesses. And there was also a notable loss connected to a property they are looking to sell, which is a one-time hit. All these numbers roll up into earnings per S-Hair. And for this quarter, the diluted earnings per S-Hair came in at 65 cents. That is a big leap from 29 cents a year ago, showing that the company is becoming more profitable on a per S-Hair basis. When we look at the cash flow statement for the 9 months that ended in September 2025, we see that operating activities generated a very healthy $17.7 million. This means the core business is bringing in a lot of cash, which is crucial for any company's long-term health. Digging into the notes can reveal some really important nuances. For instance, Note 7 talks about their allowance for credit losses. The money they set aside for loans that might go bad, this allowance increased slightly to $23 million from $22.4 million. The bank is being cautious here, which is wise, especially in uncertain economic times. Note 7 also gives us a peek at collateral-dependent loans. These are loans where the bank heavily relies on the value of the collateral, often real estate, to get its money back. Their loans secured by real estate make up a significant portion of their problem loans, but the bank seems to have a good handle on managing this risk. And speaking of risk, let's look at asset quality. The report shows that non-performing loans, the ones that are really unlikely to get paid back, are at 1.86% of their total loan portfolio. That is a manageable number, but something to keep an eye on. Now let's talk about something the market loves and hates: interchangeably fair value measurements. This report also details how they value their assets and liabilities when market prices are not readily available, especially for things like complex debt securities. The bank uses a tiered approach, and it is interesting to see that a significant portion of their fair value measurements fall into level 2, which means management has to use a lot of judgment and estimates to value them. This is where we see some subjectivity. reaping into their valuations. Looking forward, the company has commitments to lend more money in the future, totaling over $407 million. These are essentially promises to lend that haven't been used yet, while this shows confidence in future lending opportunities. It also represents potential future risk if those loans end up going bad. And here is a major development one that could change everything for Middlefield Banc Corp. They have entered into an agreement to merge with Farmers National Banc Corp. This merger is slated to close by early 2026. This is a significant move that will likely reshape the company's future and its market position. So what does all this mean for Middlefield Banc Corp? Based on these numbers and this upcoming merger, well, the bank is definitely growing both in assets and profitability. Net interest income is up significantly, and their loan portfolio is expanding. While there are always risks in lending, especially in commercial real estate, Middlefield seems to be managing these well with a solid allowance for credit losses and a close eye on asset quality. The upcoming merger with Farmers National Banc Corp is a game changer. It could bring significant synergies and a stronger market presence, or it could introduce new integration challenges. Only time will tell if this merger will be a home run for Middlefield's shareholders. What is your take on Middlefield's latest financial report and this big merger news? Let me know in the comments below. If this deep dive was helpful, make sure to hit that like button and subscribe for more unbiased financial analysis, and don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching Corporate Decoder, and we will see you in the next one.